Hey everyone, and welcome back to another video for today. So let's talk about two growth companies that not many people talk about. Although one of them is in my personal portfolio, it's not like I cover it each and every month. It's the one you're seeing on the screen right now. It's Mercadolibre. Yes, it's already quite big. It's a market cap of $103.4 billion. And some might say it's expensive just because you're looking at a forward PE, which currently is at 46.6 times. But as you know, in my opinion, Mercadolibre is one of the best companies around with excellent management and a great track record. We're going to talk about the company, some metrics, growth metrics for the company, a reverse DCF as well throughout this video. And then the second company is a company in the semiconductor industry. No, it's not NVIDIA. No, it's not Intel. So rest assured, it's going to be, well, it's not something new because we've talked about that company and I believe it's going to report earnings pretty soon, but it's a company that its stock has not been doing that much recently, so maybe it's time to revisit that. Now, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. For support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so Mercadolibre, like I said, has a market cap of $103.4 billion. Right now, the current average analyst price target sits close to 10% higher than the price we're at today. Year to date, the stock is up close to 30%. With Mercadolibre, even though the stock has gone up tremendously in the last couple of years, you can clearly see here that forward PE, EV to EBITDA, price to sales, price to free cash flow are all lower than its 5-year mean. Why is that? Well, because fundamentally the company is now much better, more profitable than before as well. Plus, it's not expected to slow down. Well, maybe slowing down a little bit, but it's not expected to be a no growth company or a normal growth company, shall I say. If you look at price earnings to growth, it's at 1.71. My book, that's not expensive. It's not the cheapest one that we've seen. No, we've seen those close to 1. Right? I think AMD is close to 1. We've got Meta, we've got Alphabet as well. Those are also in those areas. But 1.71 for a company like Mercadolibre, I think is not an expensive price to pay. Again, these are pricing metrics. Now, looking at what has happened in the last couple of years and what is expected from the company in the next coming fiscal years, we can see the following. Revenue growth has exploded, of course, in the last couple of years. Now it's normalizing a little bit, still expected to grow 41.6% in fiscal 2024, and then decelerating to what the expectations are right now, 21 to 20% year-over-year growth in fiscal 25 and 2026. With regards to free cash flow, right now in the trailing 12 months, we're at $5.62 billion. But for fiscal 2024, that's expected to be closer to $3 billion and then actually dropping in 2025. Then 2026, a reacceleration to $3.12 billion. And this is what currently the market is expecting. Well, Mercadolibre has always exceeded expectations. And to be honest, if we zoom out even more, look at total revenues, look at free cash flow in the last couple of years. Total revenues last 12 months from Q4 2019 has grown by 645%. If we look at free cash flow, that has grown 1,690%. Amazing. Looking at gross profit, net income, gross profit margin, and operating margin, again, the same trajectory, although in the last couple of quarters, yes, we have seen, again, this is last 12 months, we have seen operating margin and gross profit margin come down a little bit. But to be honest, nothing to be afraid of. Moving on to some analyst commentary, one from Morgan Stanley. They talk here about the Argentina aspects of things, how Argentina's recovery could help a company like Mercadolibre. They also have a price target of $2,500, which of course is much higher than the price we're at today. They say here, what's new? A MELI Argentina update points to recovering consumption trends on its platform in the country, including item and GMV accelerations during Q3. If you want to read the whole thing, I suggest you pause the video. Moving to Jefferies, here we have a base case, upside scenario, and downside scenario. The downside scenario sits at $1,300, the upside scenario at $2,900, and the base case at $2,250. Under the investment thesis, where they differ, they say here, MELI has grown revenue, EBITDA, earnings, and assets at around 40% CAGR since 2006. We assume some slowdown to 24% revenue CAGR from 23 to 2028, following the accelerated growth between 2019 and 2023, boosted by COVID and capital raising by MELI. Nonetheless, MELI has now clearly established itself as the leading e-commerce player in Latin America. By the way, population in Latin America is close to double that of the USA. So MELI has now clearly established itself as the leading e-commerce player in Latin America and stands to benefit from ongoing penetration growth. We expect credit to be a key growth driver and a major area of investment in the coming years. With rising monetization and profitability in commerce, and with multiple sources of funding from the fintech operation, that's Mercado Pago, MELI has the capacity to fund significant further credit growth in the coming years. That's their thinking, and of course you can look at the different scenarios right now on the screen. Now we do have a downgrade from JP Morgan. They downgraded MELI to neutral from overweight, but the price target still sits at $2,400. We rate Mercadolibre as neutral. On one side, the company has a very promising long-term outlook, with LATAM e-commerce still being very underpenetrated, advertising growth having the potential to significantly lift margins, and the company having a solid claim to a relevant share of the consumer banking market in the region due to its advantages in customer acquisition costs as the largest e-commerce player in the region, and information advantages given its proprietary e-commerce transactional data. On the other side, MELI is still in an investment phase and is unlikely to meet or beat consensus estimates given increasing expenses with logistics and the ramp-up of the credit card business, which carries a structurally lower margin. I mean, yes, it's a company that's worth over $100 billion, but I agree, it's still in the investment phase. Now, here are some comments from the CEO. He says, "We have a lot of room to continue growing in e-commerce." He also said the company is increasingly pushing loans to consumers and sellers on its platform, in turn driving sales. On our fintech platform, Mercado Pago, we're really just scratching the surface of all that we can do. I think Mercado Pago has enormous opportunities ahead. He continued by saying he was not losing sleep over the stock price, but focusing on growing the business organically in Brazil, Mexico, Argentina, and increasingly Chile. We don't like buying market share, we like building market share. I mean, what a line. And so, right now, if we look at Mercadolibre, we've seen that the free cash flow trailing 12 months right now is, of course, much higher than the number that you're seeing on the screen, but I'm taking the estimated number for 2024 because, well, the difference between the two is basically a 50% difference. So whatever you're seeing right now, of course, the trailing 12 months one would be much lower. Now, if we take this $2.83 billion in free cash flow, terminal growth rate of 3.73%, and a discount rate of 7.69%, you basically take the terminal growth rate plus the implied equity risk premium, and you get that number. Of course, then it's up to you if you want to add execution risk or not. That's up to you. But currently, the implied growth rate to justify today's price is 7.8%. It has to grow free cash flow by 7.8% in the next 10 years to justify today's price. Do you think that's fair or not? In my opinion, that's very fair and actually doesn't make this company look extremely expensive. You see, that's the problem when you just look at forward PE and you're seeing numbers like 46 or 50 or whatever. Then you're automatically going to say, oh, that's high, I'm not touching this company. But then when you do something like this, or you do a complete normal DCF valuation model, whatever, you actually find out that, actually these companies, just because the pricing metric is high, does not mean that it is overvalued. So that's just my thinking behind this. Moving on to company number 2, and that company is called ASML, a company that is a bit bigger. It has a market cap of $325 billion. Now, over the last 5 years, it has done tremendously. It's up 252%. Year to date, it's up just 10%, which means, well, it's underperforming the index. And in the last couple of months, it's actually down 21% on China weakness, on weakness in memory market. Intel might impact it as well. Plus, 2024 was going to be a slowish year for them, but 2025 is the year where we see growth reaccelerate. You can also see this in the analyst expectations here at the bottom of the screen. Now, with all that said, the current average analyst price target still sits 31-32% higher than the price we're at today. And just like with Mercadolibre, forward PE, EV to EBITDA, price to sales are lower than the 5-year mean, but some will say again, this is not cheap. It has a forward PE of 30.9 times. Price to free cash flow, that's a last 12-month metric that we have here. That's a bit higher than the 5-year mean, but price earnings to growth 1.43, so even better than Mercadolibre. And so with regards to ASML, we can look at total revenue and free cash flow in the last 12 months and what's expected in the coming fiscal years. Like I said, 2024 is going to be a down year where it's basically flat compared to 2023. With regards to free cash flow, a bit of the same. But then we see it reaccelerate in 25 and in 2026. But then if you zoom out a little bit, well, overall, revenue has gone up. You can see it, yeah, it goes in waves a little bit, but it also has a huge backlog worth billions of euros, not dollars actually. Free cash flow, yes, it's true, but this is again free cash flow in the last 12 months, is coming down or has come down, but you can see it rebound a little bit. And as we've seen here, it should grow back in 25 and 2026. Overall, gross profit margin is still above 50%. Operating margin is still around 30%. Net income is, of course, fluctuating with the operating margin. Looking at net bookings, it's going to be interesting to see what Q3 will show us. Also, EUV net system sales and used lithography system sales. What will that show us? We've seen Q2 was better than Q1, but then again, Q2 is usually better for them. So let's see what happens in Q3 and if they can give us some more color in what they see happening in 2025. Now, looking at the Q2 numbers, you can understand that every time we talk about China or Southeast Asia and some geopolitical stuff there, you can understand why a company like ASML could get hit. Because if you look at the region, I mean, China is 49% of net system sales, right? 49%. South Korea, 28%, Taiwan, 11%. So just Taiwan and China is already 60%. So yeah, if something happens in that region, definitely that's going to hurt ASML, plus export restrictions, shipments, etc., hurts the business. But usually what happens is you find common ground. Just like Nvidia, you might not ship them the latest technology, but maybe you might ship them something else. Then as for the outlook for Q3, total net sales should be between 6.7 to 7.3 billion euros, gross margin between 50 to 51%, which is about the same as we've seen right now. And 2024, as we know, similar total net sales with a slightly lower gross margin relative to 2023. And so with ASML right now, if we take free cash flow trailing 12 months, $2.96 billion, apply the same thing we've done before, terminal growth rate, discount rate, we get an implied growth rate of 21.9% to justify today's price. Now, that is higher than Mercadolibre. And as we've seen, 2024, not a great year, so trailing 12 months free cash flow might not show what will happen in the future because they expect 2025 to be a much better year. But we cannot, of course, play around just because we want to have better growth rates here to justify our view on this specific company. No, this is what we got right now. If next quarter we get better numbers, free cash flow trailing 12 months will change, we can try it again. But right now, this is what you get. If you think that that is achievable, then go ahead. I mean, this is a company that is extremely important and could be regarded as a sort of monopoly. So yeah, there's always going to be a premium on ASML. And if we look at what the analysts are expecting it to do, EPS is expected to grow at around 18.3% all the way through 2023. Well, the growth rate is 18.3%. So you get those numbers here. You can then play around with the pricing metrics here. And this is the upside, and with price to sales, the downside that you're getting if we go all the way through 2033. So overall, that's about it for me in this video. Of course, if I had to choose, I would go with Mercadolibre. Plus ASML, like I said, is expected to report their Q3 figures pretty soon. So if we see some weakness in the stock, I do think that you cannot go wrong with a company like ASML. So that's about it for me in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.